What's up, team? My name's Alec Rosario. You're watching Matters of Money. So glad you're here. Hey, have you ever had questions about life insurance? What it is, how it works, what works for you and your family? Well, I hope to answer that question for you today. Stick with me, we'll go far. So let's jump right in. First things first, I am a professional financial advisor. Have been for the past almost decade now, always helping people to make money on their money, and love to do that for you today. I will say that this video is intended to be general, broad, educational information, not specifically to you and a specific recommendation. You should always speak with your own professional financial advisor, insurance agent, CPA, anybody that helps you make decisions with regard to finances. That said, I am a financial advisor and can help, so if you'd like to meet with me, shoot an email to the link below. Love to set up a time to chat. So, I want to start with this discussion about life insurance by discussing what insurance is. So conceptually, insurance is transferring risk. So, Alec, what the heck does that mean, right? Like, speak English to me. What does transferring risk mean? Well, taking the possibility for financial loss away from yourself and giving it to someone else. In most cases, it would be an insurance company. So most people know insurance by talking about their auto insurance. So I'll use that as an example. You pay for auto insurance on a monthly, quarterly, semi-annual, or annual basis. Basically, you're saying to the insurance company, if I get in an accident, you're going to be the one to help pay for all the expenses that come along with it, right? So if I got to get a rental car, all the damage that I've done to both my car and also if there's another person involved, the other person's vehicle. Sometimes it even covers medical expenses, right? That is the transfer of risk. I pay you a small amount on a monthly basis, and you take care of the big cost that would come along with if there's loss that I experience as a driver, in my example with vehicles. Another thing that most people might know or be aware of is home insurance, right? If something happens to my roof, someone falls on my property, a tornado rips apart my home, home insurance is supposed to be there to help back me up. I've paid all this money in as premiums, and so now it's the insurance company's moment to step up, right? That is the transfer of risk. I pay you on a monthly or however often to be the one to take care of all the costs associated with me experiencing some sort of loss in my life. So now with regard to life insurance, same concept. Transferring the risk of a premature death to an insurance company. So when you say it like that, I think it makes a lot of sense. At least it does for me. Hope it does for you too. Hey, by the way, if you learned something right there, hit that subscribe button, hit that notification bell so you can be kept up to date on all the content we're putting. So now that we've talked through the transfer of risk and we've talked about life insurance as a broad example, in that it's the transferring of risk from you to an insurance company, I want to talk about the two types. So generally, there's term insurance and there's permanent insurance. Term, set time frame, and then it expires, and then perm is your whole life. So that's 30,000 foot. Let's jump more into the term today. Another video will describe the permanent and the different options available to you. But today I want to talk about term insurance, how it works, what you need to know about it. And I've got 5 things that I think are going to make it very simple and easy for you to understand. So, number 1, you can set the time, you can set the death benefit, and you can set the premium amounts when you start the policy. So mortgage is an example where people might know what I'm talking about and know it pretty quickly. Generally speaking, a mortgage is maybe 15 or 30 years. So you set it up in equivalent time frames to whatever your mortgage is. I've got a 15-year mortgage and I take out a 15-year term policy. If I die prematurely, then the mortgage is paid off and I don't have to worry about for my family. Another example might be, I don't know, 40 years old, I've got 20 more years until I'm done working, and so I take out a 20-year term policy because I know that if I die prematurely, my spouse or my children need to be taken care of, and so I set it up based on how long I expect to be working. You can make the term policy based on whatever you want. If you're a business owner, you can do it on the length of time that you expect to be in business. A professional athlete might do it based on how long they expect to be professional. Others might use it based on a myriad of different reasons, but all of it, I want you to be thinking about being intentional with your family, your situation. How long do I need to cover myself for? So again, you can set the time, you can set the death benefit, and you can set the premium. That's number one. Number two is that you can base it on your needs and your goals. So I've already kind of gotten into this a little bit, but I would want you to be basing it on a couple of factors. The first one is debt. How much do I have in credit cards, auto loans, mortgages, student loans, medical bills, anything that's got an interest rate associated with it. And if I died tomorrow, I'd want my family to be able to pay that off, right? So that's the first thing. The second thing that you would want to cover as far as your needs would be income. If I died tomorrow, my family, how long would I want them to be taken care of? If I say I expect my wife and son to be taken care of no less than 10 years, and I'm going to base it on my income, if I'm the only income earner, or if I'm one of two income earners, then I just divide it in two, and that's how much I would need, right? But I want to base it on a specific dollar amount over a specific time. So for example, the next 10 years I want 50 grand covered per year, no matter what, that's it. Then I would need a $500,000 policy. Now, if I have that same example, 50 grand per year for the next 10 years, and I have 100 grand in debt, then I really need a $600,000 policy, right? So you want to base it off of what your goals are and what your specific situation is. And then the final thing would be your goals. So for example, I want to pay off my debt, I want to make sure my family is taken care of, but I also want to maybe give to a charitable organization or make sure my business continues. So that's an extra $250,000, $500,000, right? You can see how these numbers add up. In my example, I'm at 600 grand already, plus I want to say another, $250,000. I'm at 850 grand in total expense that I need to cover, and so therefore that's how much I would want to get in a term policy, and that's how I start my conversation with the term policy, as opposed to not knowing. Speaking of, someone's calling to get their term policy right now. The third thing you need to know about term insurance is that the younger you are, the cheaper the policy. The healthier you are, the cheaper the policy. If you're a woman, the cheaper the policy. So, the older you get, obviously, the more your body starts to deteriorate, right? If you got health issues, then the transfer of risk that the insurance company is taking on is greater if there's health concerns, right? If you're using tobacco products, cigarettes, nicotine of any sort, chewing tobacco, cigars, it increases the probability that your premiums, your monthly costs, are going to be higher. So all that to say, the younger you are, the better it is to start your term policy, especially in your 20s and 30s. In the 40s it starts to hike up a little bit, but in the 20s and 30s, generally speaking, again, your specific situation could be very different, but it's going to be less than $30-$40 per month. But in your 20s, it's probably $15 or less. So younger you are, healthier you are, and generally speaking, if you're a woman, you're going to be more inexpensive than a male. And the reason being for that is women, generally speaking, will go to the doctor more, get checkups more, and so therefore health concerns are diagnosed faster and quicker, and so they have less time to progress. Versus males, they got that macho man, I want to be a macho man tendency, and so they don't go to the doctor as often. So that is the third thing you need to know. Younger, healthier, and no tobacco use, generally you're going to be less expensive. The fourth thing is that you can actually, some policies, not every term policy, but some policies allow for you to convert it. So take it from a term policy to a whole life or permanent policy, which allows you to add cash value. And we'll talk through cash value in the next next video that we put up. But convertible policy is something that you would have to know upfront whether or not is capable of doing that in order to eventually take advantage of it down the road. Now, a reason a person would take advantage of a conversion or make it go from a term policy to a permanent policy, again, is that cash value. They want to make their premium payments that they're putting into the policy grow and add up over time, so that one day they might be able to access it and take money out of that policy. With a term policy, there is no pulling money out of it. You put it in there, that money's gone, the insurance company takes it, just like your auto policy, right? Once it's in there, there's no getting it back. They're not giving you that money back. So that's the fourth thing. You want to be cognizant of the ability to convert your policy into a permanent policy. And you would know that up front before you even get started with it. The final thing, the fifth thing that you need to know about term policies is that generally speaking it's going to be cheaper and less expensive to go through your employer. So the reason why is because with employers, what they're doing is they're saying, hey, company A wants to do business with insurance company C. So company A says, hey, all the employees within our company is going to use your platform to get insurance, right? And so insurance company C says, oh, yay, yippee, right? A bunch of people who are guaranteed to use us, so we're going to give everybody a discount because there's so many people, right? And so, you might be one of 250 people that use their policy. They're going to give you a discount. It'd be like walking into Sam's Club versus Walmart, right? I can buy bulk and get a bunch of policies versus going to Walmart and getting one policy. It's going to be more expensive per item in Walmart than it would in Sam's Club. So generally speaking, using your employer is going to be less expensive than using a broker, which would be any of the insurance companies out there who do life insurance. If you Googled it, I'm sure you could very quickly find a bunch of people who help with life insurance. As a refresher, here are the 5 things. Number 1, you can do a set time, set death benefit, and set premium payment that you make on a monthly basis. The second thing is that you can base it on your needs and your goals, right? How much debt do I have? How much income am I trying to replace? And then do I have a goal to maybe fund a charity or a business, make sure that something is funded when I pass? The third thing is that the younger, healthier, and if you do or don't use tobacco, then it's going to be cheaper. And if you're a woman, then you're gonna get the best deal possible. The fourth thing is that you can potentially have a policy that allows you to convert to a permanent policy, which essentially gives you the ability to take out cash value eventually from the policy. And then the fifth thing is that an employer term insurance policy is generally speaking going to be less expensive than a broker or going to one of the insurance companies out there. I hope you learned something. If you did, hit that subscribe button, notification bell, leave a comment, let us know what you thought, let us know how you made your decisions on life insurance originally and how this may have helped you today. So I'm glad to have brought you the information. Again, hit that subscribe button. We're going to be coming out with more information and content soon, so you want to be kept up to date. I appreciate you guys, and keep on making money. Thanks.